kind of the shadow banking economy that's happened, because in the country right now, Blue Owl, people like that have come along, that there are a lot of commercial bankers in here that are now having to compete with unregulated capital out there. What's kind of your view on how that's grown so much in really the last five years or so, and that's unregulated outside of your roots? So
yeah, so it's really been about 10 years, yeah. And I think a lot of it. And again, I was also a financial institutions analyst in the early part of my career, so I followed the regulated banking system, the insurance companies, S&Ls when there were S&Ls. And I think private credit developed as a regulatory arbitrage because post-Dodd-Frank, the regulatory straitjacket around our regulated institutions was so tight, making loans became very difficult. The big got bigger. We lost more than 50%, 50, of our small and community banks because it went from too big to fail to too small to succeed. Mm-hmm. And I think like this growth outside the system. At Treasury, we have been pushing for loosening of the regulatory straitjacket. Oliver Wyman's words, not Treasury's. They believe that our changes in regulation, that I don't change the regulations, I guide them through a convening mechanism as the chair of the Stability and Oversight Council, but OCC, control of the currency, FDIC, and the Fed, that's probably created 2.5 trillion of new borrowing capacity. Mm-hmm. So 2.5 trillion of new borrowing capacity for the regulated industry. So now private credit has a competitor. What we are concerned about, or what our focus doesn't have to be a concern, is what is the relationship between private credit and the regulated sector. So our private credit funds borrowing from the regulated sector. You saw there was a transaction yesterday where Blue Owl sold a tranche of their loan portfolio to 3 pension funds and a captive insurance company. Mm-hmm. So that's moving it into the regulated industry. And you see almost every one of the private credit companies has a regulated entity. So now Treasury gets involved. So we are concerned, I am concerned with watching how does this get to the regulated financial system. I, as maybe some people in this room did, successfully predicted, and unfortunately successfully predicted, the subprime crisis that then turned into a banking crisis. And you could see like these CDOs and exotic instruments on bank balance sheets. So our job is to make sure that the regulated system is not affected by private credit. And we'll see. I think that private credit has been an exciting new feature. I think it bridged the gap, especially during the tough and tight regulatory times. I think that they were there during COVID when some of the banks were frozen, and I hope that they've been prudent in their loan portfolios.
But a lot of the private funds are doing extend and pretend. We see that a lot in the real estate industry, where a commercial bank would have to call a loan and they're pushing out. And then even in the private equity side, the continuation funds that they have that aren't sunsetting, they continue them on. Isn't that just kind of pushing problems off into the future that, as a Secretary of the Treasury, you kind of have to look at it and go, what is really going on behind the curtain that you don't really get a chance to look at?
We have the ability to peel back the curtain, and
even on a private equity deal.
Oh, sure. Mm-hmm.
Okay. Be careful, a lot of them are out here, don't they? Yeah. So, yeah.
When you get a call, the Secretary of the Treasury wants to come and see you, you return the call.
Get that.
But But again, that we want to gauge, could it have any effects on the overall economy? Thus far, it's been very additive. But again, how does it affect the regulated system? And we want to prevent contagion. The other thing that I would say, and everyone in private credit, private assets, should listen to this, because at Treasury, we are part of the rulemaking process for private assets going into retail. And this administration, led by Treasury, is committed that the individual investors will not become the dumping ground for residual.
And you're talking about the 401k plans.
The 401k plans specifically.
Right.
If there is something rotten, it is not going to be handed to the individual investors. And we are 100% with my colleagues at the Department of Labor committed to that. And look, it's to everyone's advantage that should individual investors be able to diversify into private assets? Definitely. But if the timing is bad, if there are a set of malactors, if intentions are bad, then it will be one of these things that it will be blocked for a generation. So we want to do it in a safe, sound, and smart way, both for the private equity firms and, most importantly, for the American investing public.
Well, Wall Street's looking at this. Trillions of dollars are going to be unleashed into things that normally they weren't able to invest in, real estate and things like that. So there is a thought that valuations in hard assets are going to go up because now people have access. Those small dollar investors can go in there. But you're right, are the fees laid on it so heavy by the big firms and things like that? But you can't really regulate that.
Well, we can't regulate that, but what we can think about, some things to think about, perhaps private investors shouldn't get a continuation fund. Mm-hmm. Like if you weren't in the original fund, then a private equity firm shouldn't put 401ks into a continuation fund. Mm-hmm. If there's a credit that's already in your private equity business and you do a follow-on loan, then maybe that's not appropriate. Mm-hmm. Maybe just de novo loans to new entities would be more appropriate. Well, so again, we want to make sure that the 99% of good actors do not get polluted by a couple of bad actors that seems to happen every couple of decades.
So let's go back to banks for a second. I've served on the board of some smaller regional banks here, and so many have been, in the past, have been rolled up, and then really mergers until the Trump administration came along had pretty much died for 4 years, and people doing de novo banks, that's kind of gone away in such. So what's your view on the banking system in the United States? Do you feel like it should consolidate around a few very, very large banks, or do we need to have a lot of regional community banks that really have kind of built the country?
Yes and B. What's happened, again, I think the regulatory morass just got too big to fail, too small to succeed. One of the things that I've been working on, and it's both sides of the aisle, and it's Senator Haggerty from Tennessee, Senator also Brooks from Maryland, are pushing for small and community banks to be able to have an enhanced non-interest-bearing account. Each depositor could have one, and where there's a much higher level of deposit insurance. Let's pick a number, because it seems like $10 million right now. Because
where is it today? It's like 100,000?
250.
200. You want to take 250 to 10 million for a single account?
For a single account, okay. Non-interest bearing, and I'm informed by this by what happened with the deposit volatility during 2023, when we had the second, third, and fourth largest bank failures, despite Senator Warren's regulatory morass. I always say she's a financial agoraphobic. Right? Like, how do you not get hit by a car and never come out of your house? But like this high level of regulation, don't make any loans, you'll never lose money. But somehow, with all these regulations, all this the overbearing supervision, we had these bank failures. But what happened during those bank failures was the money ran to the very largest banks. And I'm saying that, like, even U.S. Bancorp, which I think is the fifth largest bank, lost deposits to J.P. Morgan. So like this moral hazard of the biggest banks, or the public believing that the biggest banks have unlimited insurance in a crisis, and then the money leaves the smallest banks, and the money that leaves the smallest banks, for any of you who have small businesses, for any of you who are on the boards or own smaller community banks, it's usually a payroll account. And it could be a lawn service company, it could be a restaurant, but payroll account can be several $1 million. And that moves to, it moves to Wells Fargo, because they believe that government would not let anything happen to Wells Fargo. And payroll account then ends up there, and Wells Fargo are smart bankers. So they said, well, why don't you, we don't like just having the payroll account, bring your other accounts over, and then all of a sudden a community bank that's had the same client for 100 years, it's gone. Mm-hmm. So we think that this is a very smart and effective way to allow the small banks to retain business borrowers or high net worth individual or depositors over a long period of time. And these small banks are important. That up until December 12th, I was a farmer. I was involved in the agricultural business, mm-hmm. and I had to divest my holdings. And that sometimes on Saturday morning I turn on farm radio, and you listen to farm radio. And I remember listening after all the bank, the bank failures in 2023, and it's exactly as you would expect. These farmers are saying, look, these out-of-state bankers, they don't go to your church. They don't play Little League baseball with your son. They don't play softball with your daughter. You didn't go to high school with them. They're not in the local community. And I think there's nothing like these local community banks. They drive I think it's 70% of real estate lending. They drive ag lending. They drive small business lending. And when you think, Wall Street versus Main Street, it's really time for Main Street to do better. And I think Main Street can only do better when the small banks do better.
Well, we're fortunate. You're probably the first Treasury Secretary we've ever had that listens to farm radio. So I very much appreciate you understanding what's going on in the rest of the country. Now, real quick, this is a subject we could have had the entire hour to talk about, but I'm going to break it into two parts, and that's AI. One is the investment in AI, and the other is the effect of AI. And so I'm going to start first with the effect of AI and the kind of slow fire, slow hire we're going through in this country right now. Because if you're graduating from college, the biggest unemployment bubble right now is kind of 19 to 28-year-olds really not being able to find a job. And then people are holding on to people longer, wondering what the effect of AI. So that's kind of, I think, what a lot of people in this room, our businesses, are like, what is this AI really going to do? And then secondly, maybe we can talk about this huge investment that's going into AI by Oracle and these companies, that different than the internet time when money went into stuff like pets.com that really didn't have a market. I mean, these are real companies putting the money up. So you can take either one of those you want.
Yeah, so I'll take both of them. One, I think it's very hard to disaggregate what's the effect of AI and what's the effect of the COVID employment trends holdover.
Okay.
Because I'm sure anyone in this room, employee retention during COVID was dire. I mean, my firm, we started paying quarterly or mid-year bonuses for the first time ever. For employee retention, when I left just over a year ago, we'd stopped that. But I think that, as you said, slow to fire, slow to hire. I am very optimistic about the overall labor market right now. I'm very optimistic about the economy. That historically, when I used to have to analyze economic data to make market bets, I always found that you were going to see an acceleration in the employment market when the temporary staffing companies did well. And temporary staffing companies are now reporting very good earnings, very good demand, and historically that morphs into long-term demand. We've also seen about a 12 or 14% CapEx boom in 2025. Traditionally, CapEx booms are followed by labor booms. So, we'll see what the effects are of AI. You'll probably be able to figure out who I'm talking about when I give the breakdown. I had a major credit card company at Treasury about a month and a half ago, and I asked the CEO, what is the effect of AI on your business? And he said, well, on our collections and billing department, we're definitely taking down employees, but we're moving them all to the travel department. So it may be a reallocation, and may